Hello, everyone, and welcome to Super Stonk Brothers number 6. Today, we're going to talk about 2 recent IPOs and the potential future prospects of these 2 companies in our humble opinions. And these 2 companies are first AppLovin, an ad network, as well as games company. And the second is Coinbase. And I will say that Steve and I do work in the games industry. So there are certainly a lot of things that I think that we can speak to that you definitely will not know about from other sources that talk about AppLovin in this case.
We have sort of not what I would call insider information, but industry information on AppLovin. So you're going to get a little bit more value add out of us than you usually do.
Yeah. So AppLovin, maybe high level. What are your thoughts on AppLovin high level, Steve?
Super high level. So my first introduction to AppLovin was when I joined the mobile games business, or the free-to-play side of the mobile games business, 2015, and they were one of our major advertising partners for the company that I work for. And so we paid them a lot of money, and they made us a lot of money. And they were kind of, I would say, middling quality. Over a period of time, their advertising business kind of got eaten up by Facebook and Google. And this is what has happened to all of the networks that are not Facebook and Google, basically. The non-self-attributing networks is what we call them. They've all kind of gotten in trouble over time. So I think a few years ago, they started a pivot into becoming a games publisher. And this is problematic because they were still selling advertising to us while competing with us in our business. And that's obviously a massive conflict of interest. Not super ethical, but they've managed to complete an IPO. And as such, we have sort of additional information on their financials that we would not be privy to as a private company.
Yeah. And just to be clear, we are not investment advisors, but from our humble opinions, we do have some thoughts in terms of AppLovin.
Yeah.
From my perspective, I think the 2 things that bother me are, one, so I do think there is an ethics and integrity question out there. There's a lot of rumors in the industry. There's a lot of rumors in the industry. Now, we're not going to say one way or the other whether they're guilty or not, but certainly a lot of question marks out there. And then secondly, just in terms of the potential growth potential for them in the future, it does seem, at least to me, that there are some question marks, and we'll dive into that. Yeah. But one of the things I'd like to highlight, so I did have a chance to quickly go through the S-1 last night, and some of the things that I wanted to highlight is, one, that we don't have full disclosure. And so if you look at the S-1, one of the things here that you can see is this quote: "We have continued to take advantage of certain reduced disclosure requirements." And the reduced disclosure in particular that they call out is that we will have reduced disclosure around selected financial data and executive compensation agreements.
That's always a great way to start an S1, is basically to reveal that they're not going to disclose everything.
Yeah. I mean, another thing to be aware of in terms of the company is that they do have a significant amount of debt. So aggregate principal amount of $1.82 billion. Just looking at their financials, you'll see that, that they are paying a fairly significant amount of money in terms of interest expense. So last couple of years has been in the, $70 to $80 million range. And that the other thing to understand about their business is that as Steve mentioned, today, half of their business is advertising and half of it is on the gaming side, the content side of the business.
They're still executing that pivot away from being an advertiser, and that doesn't happen right away.
So one, I think that you have to question, in terms of the advertising business, how big is it? How much bigger is it going to get? And is it fairly tapped out? Now, a lot of people in the games industry had kind of theorized that they would make a pivot, kind of were able to foresee that ironSource would also kind of make the same kind of move, just because we saw that as Steve mentioned, with Google and Facebook taking so much of the advertising market, that the players that weren't Facebook and Google will be looking for other avenues, other paths to grow their business in some way.
There's no way they can compete with Facebook and Google. Facebook and Google have too much data on users, so their targeting is superior. So you get superior return on ad spend as opposed to just showing like banner ads in games, right?
Right.
Or whatever.
Yeah. And so here, one of the things to realize is that, again, it's like 50-50. The ads business is, unfortunately, you can see here, when we look at the ads business, that they actually lost customers from 2018 to 2019, going from 192 to 167.
I can tell you that they lost us as a customer.
Yeah, and likely this loss had to do with that, with kind of stories coming out, rumors coming out about them using some of their customer data against their customers. And so basically, the way you should understand this as a listener is that when you are an ad network, you kind of have access to the data in terms of how much money is being spent on ads, the kinds of ads that are being run, and the performance of those ads. And so if you kind of see what's happening in terms of different genres of the games, you'll know kind of the performance and how well a game is doing and what kinds of ads will help drive that game to be successful or not. So if you then make a game similar to a game that you see is performing very well, you basically have a competitive advantage. You can make competitive products and you can see exactly how much to spend, and how well some of these products can do.
Yeah, and they executed this strategy brilliantly with Matchington Mansion, right? That's one example of this.
So Matchington Mansion versus a lot of the other sort of match games that were doing well at the time.
Match 3 games, yeah, and I think that game entered the top 10 and was there for a while.
And there was actually, going back like a year or two back, Glue Mobile had mentioned that they were trying to do user acquisition on one of their Kim Kardashian games, but that there was a bidding war between two companies who weren't named in their financial filings. But those two companies are most likely, it was between AppLovin and Playrix.
Yep.
But just speaking to the business, aside from ethics, just looking at the business aspect of this, we can see that the revenue per enterprise client has declined here in terms of the growth. Not that it's declined, but that the growth is kind of slowing down.
Yeah, you're talking about the acceleration, right?
That's right. That's right.
Negative.
And 2020 was one of the biggest years for gaming ever. And so you can see here that you have to imagine that this is either going to slow or potentially even decline. The other thing that's happening on the ad side of the business is what's called Idfa Deprecation, meaning the ability to target and get higher ad CPMs is likely going to go down. There are people in the industry who kind of guesstimate that might be as much as 30% decline, but depending on how that plays out,
targeting effectiveness. Yep.
You could imagine like what would happen if this number declined by 30% and we have kind of a post-COVID hangover where we don't have as strong of a year as we did last year. Then you can imagine that this number and this side of the business is potentially challenged.
Yeah. Well, so the name of the game for AppLovin, Joe, correct me if I'm wrong, it's to very quickly replace and exceed that revenue with the growth of the game side of the business, right? And so part of what you're seeing here is them establishing a walled garden that from a data perspective, whereby they own all of these games or they're partnered with all of these games, they're publishing them, whatever the case may be, they expand that garden, put more and more games in, and then they're allowed to share data between those games and advertise between those games effectively because IDFA deprecation does not affect the ability to share data on a first-party basis. If you own all those games, it's totally fine, it's totally kosher, according to Apple, to share data. It's when it's the third party relationship that's the problem. So they're like, we're just kicking the third party relationship to the curb, right? So we're gonna like basically accelerate the decline of this side of the business in order to boost the first party side of the business.
Yeah. Although I will say there's different schools of thought on that. That's certainly one potential scenario and one in which that I think they have carefully considered. But the other scenario, which we can talk about, would be one in which it has to do with the Adjust acquisition, where, so Adjust is what's called an MMP, a mobile measurement partner. And Adjust has a vast trove of data against many, many games so with an MMP, if you are a games company, for example, any post-install type of event, you will send that data to your MMP. And so they have all sorts of data about like ARPU, average revenue per user profiles, LTV profiles of a lot of different types of games. And so the other kind of school of thought would be, yeah, they might be just giving up on third-party a sort of like third-party ad network attribution part of the business. Or if they could take that data and then post IDFA deprecation, there is still some level of attribution. It's called SK Ad Network. Yep. And you get like 1 day of data against a single conversion event of your choosing.
Yep.
Now, I mean, without going into too much gobbledygook about how all this stuff works, the simple way to think about it is you have like 1 day to try and figure out what kind of player you have. Now, if you have this vast treasure trove of data and you can say, well, this player actually is going to monetize like this, that's very, very valuable.
Yeah. On the other hand, this is another really unethical thing to do because Adjust operated as an independent business with hundreds of partners, thousands of partners. I don't know how many clients they have. Again, like we've been a client of theirs, right? Yeah. And we never thought that they would sell to a competitor that would then like data mine, like really detailed play data from our game, right?
Right.
I mean, so this could open them up to legal action, I would imagine.
Well, yeah, I mean, who knows how this plays out, but that's another school of thought. I'm just talking about the potential scenarios.
Sure. Yeah.
Right. And so I think the other thing that I would be concerned about is when we look at like sales and marketing, clearly there was an increase because as they shifted into more of the games market, that requires user acquisition costs and things of that nature. Yep. But I would say even then, this is pretty high. If you look at public companies like Zynga or Glue, sales and marketing costs are typically somewhere between 20 to 30%. And here they're actually spending quite a lot of money on the sales and marketing side relative to other, if you were to just consider them a gaming company.
That's a warning sign for sure, because these guys are supposed to have a lot of data, right? So, and that they're a freaking advertising network. This is what they're supposed to be good at, right? Just driving these costs lower.
And you can see here, this is kind of the breakout between the business revenue, the ad network, and the consumer revenue, the games business. So you can see there's tremendous growth on the games business. This is through acquisitions. But you can see here that the ad network side, 19%, the growth is slowing.
Yeah.
And the main growth has been coming through the games business, the acquisition of additional game studios, and that side of the business. So you really have to think about then, how much growth is there? Again, we believe that the ad side of the business is likely going to be a little bit challenged. And I'll make arguments on why the game side of the business may also be potentially challenged. Now, the company itself, when you look at the net income, net income is negative. And so one of the things that they're asking you to do, and the reason why people are so excited and why AppLovin commands such a high valuation, despite the negative net income, is because of the growth of the top line, the revenue, and the company's asking you to judge the performance of the business against adjusted EBITDA, so non-GAAP measures, right? And so when you look
EBITDA
at it,
is a fancy way of saying profit, right?
it's EBITDA is supposed to be as close to cash or proxy for cash. And so when you think about the cash operations of the business, that's how you're supposed to think about it.
Got it.
And so on that basis, you see that there's pretty good growth in terms of adjusted EBITDA, or as people would, generally use as a proxy for the amount of cash generation of the business. But my argument would be that these numbers are actually inflated. And the reason why I would say they are inflated is because when you go down and kind of read in terms of how they are calculating their adjusted EBITDA, they do one thing, which is so sure, amortization, depreciation, that's fine. I would say purchase accounting impact to deferred revenue. This is fine. And so basically what happens is, like, if someone in a mobile game makes a purchase, then sometimes you'll defer that revenue. And then that's generally the difference between your bookings number and your revenue number. So this is fine. But what I personally disagree with in terms of trying to understand the actual cash flow characteristics of the business is that, interest expenses, in my opinion, are a real expense. They're having to pay that out. Also, stock-based compensation, and this is something that a lot of Silicon Valley tech companies and other companies do, is they don't include stock-based comp as part of their adjusted EBITDA measures. But here's the thing, is that is this a non-cash expense? Yes and no. Yeah, it's not. It's non-cash in terms of the issuance and the vesting, but upon exercise, that's a real cash hit to the business. That's a real expense, right?
Absolutely.
And so if you're writing checks, and then you're just saying, okay, just ignore these checks. But I don't get that. So I would personally treat this as a cash expense. I mean, I'm sure there's probably a better way of doing it, but because of the way that a lot of these companies treat this, so it becomes like you ignore stock-based compensation because it's kind of then classified under a financing activity rather than an operations activity.
Yeah.
People just kind of ignore it and treat it as if this is free when it's not. And then
even if you treat it as a financing activity, like what this means is that in 2021 post IPO, a bunch of people are going to cash in their options, right? And that means selling their options, which means lowering the stock price, right?
Yeah. So, and I would also argue that that payments in terms of acquisitions, like expenses related to acquisitions, is a real cost. It is an expense.
Of course it is. Now, I mean, they're buying assets, right? They're buying those games to include them in their expanding walled garden for that first party data.
Now, and I understand the argument. The argument is, well, wait a minute, these are one-time expenses, but actually they're not, because usually they then structure these like 4-year earnouts. So then it's like, okay, it's not a one-time expense. It's a upon acquisition, and then you've got 4 more. It's a 5-time expense, right? But then it's like, but wait a minute. Then the question becomes, okay, in terms of the long term, are the games that they acquired, are the companies that they acquired, are those assets, are they what are in the games industry considered forever franchises, or are they declining assets?
Yeah.
And so that's a big question that has to be answered. But here I would say that this, again, overstates the true cash performance of the company. So here I've adjusted these back. So sure that, deferred revenue, fine. Some of this other stuff, fine. But I've added back interest expense, stock-based compensation, and the acquisition expenses. And then you'll see here that the macro 108 adjusted EBITDA and EBITDA margin is actually a lot lower.
Yeah. AppLovin is not loving those numbers, man. That's
And just to give me a little bit of backup here, so if any of you are fans of Warren Buffett and Berkshire Hathaway, in Berkshire Hathaway's 2018 annual report, he also complains about this practice, right? And so let me just read to those on the listening on the podcast. But here in the newsletter, it states that brand of earnings is a far cry from that frequently touted by Wall Street bankers and corporate CEOs. Too often, their presentations features, quote, adjusted EBITDA, a measure that redefines earnings to exclude a variety of all too real costs. For example, management sometimes assert that their company's stock-based compensation shouldn't be counted as an expense. What else could it be? A gift from shareholders? So anyway, the point being that I believe these are real expenses and should be counted. Warren Buffett also believes the same. Now you can argue that other folks don't. Well, that's their opinion, and you can treat it as you want, but I would treat it in that way.
Yeah, the point you're making, though, it seems to me, is that this business is just not as attractive as they have caused themselves to look.
It's not as attractive as it's being presented. And then here, when you just look, ultimately, you always want to look at the cash flow statements, and just high level in terms of cash. Here you can see that net cash provided by operating activities. So in this past year, they're saying that it's $223 million. But remember, this adds back a lot of the expenses that we talked about.
Right.
So then if you then accounted for stock-based comp, acquisition-related charges, that's about 130 million in expenses. And so the 2020 net cash provided by operating activities, if you included those, would be then less than 100 million. It'd be like
90 something. Yeah.
And then you look at how much money they spent, right, over the past 2 years. They spent over $1 billion in investment activities and buying companies that will prop up and show their continued top line growth. Right.
Yeah. How much was the Adjust purchase? It was for,
that was like $1 billion or something. Was
it that much?
Yeah.
Oh my God. Wow.
And then you can see that they've been raising a ton of money through financing. And so, and here's the other thing is that this doesn't stop, right? As I mentioned before. So in addition to those acquisitions, are they one-time charges? Are we not going to see any more additional expenses related to acquisition? And the answer is no. Look at this. So this is all their contingent consideration summary here. And you can see for a lot of the acquisitions, you got future earnouts, Recoded asset acquisition, future earnout.
Yeah.
Sam Finico Games asset acquisition, future earnout. Zen Life, future earnout. Other asset acquisition, future earnout. So you got
to be clear, Joe, like this is like the very common structure for acquisitions in our business, right? Because you want to continue to incentivize the people that you bought to do work for you, right? They don't just go on vacation.
That's right. I'm not saying they shouldn't do that, but what I'm saying is that if you were to really evaluate the true cash performance from the operations of the business, it's way overstated in my opinion.
Yeah. Like the point is, these earnouts are an albatross for years, right?
Yeah.
And if you keep buying companies, and it seems like the business model now is to just keep buying companies and keep doing this, kind of like what Zynga has done, right? Then this is going to happen in perpetuity, more or less.
Yeah, but now you can make an argument, and I think it's a good argument if you were to say, well, look at Zynga, look at all their acquisitions. That's true. So Zynga was able to acquire a number of companies that have what we call in the games industry forever franchises, meaning that you have these incredibly great businesses around games that are live operated for 5, 10, 15 plus years.
Yeah, your Candy Crushes, that type of thing.
Candy Crush, Words with Friends, games like that. Fantastic businesses, great games. But the question is, in terms of the games that they acquired, how many of those games are also forever franchises versus they're going to be fully paying for those games and not getting, a lot of additional revenue over 10, 15, 20 plus years over time, right? And so I would argue that some of the games that they acquired are likely on the decline and probably aren't forever franchises.
That's just like kind of the base state of the industry. Most games are very far from forever franchises, right?
Yeah, I mean, they're out there, and Zynga's done a fantastic job of aggregating a lot of them.
Yes. And like, some games have great fundamentals, but you're always struggling against the tide of competition and whatever is coming next and new technologies and other market conditions that you can't predict. So you need to be fast on your feet. The team needs to stay and grow. Otherwise, like you're just going to bleed value.
Right. So just kind of thinking then in terms of high level. Okay. So what are the prospects for AppLovin? Well, I kind of summarized here my view in terms of their growth drivers and then the key risks to watch out for. So one, so long as they operate this ad network, they will continue to have a data advantage. They'll understand which games perform well on their ad network, which creatives perform the best, and kind of how well those creatives actually perform. This is incredibly valuable information. And on top of that, because of the Adjust acquisition, they have the potential of taking some of that data and being able to do a lot of things that can help their customers.
Right. Now, so what this does is it adds in-game data, right, to the advertising response data that you just referred to. Yeah. And so you build out a much more sophisticated profile. The other thing they can do with Adjust is use it as like bait. They can give it away free to smaller studios and say, come join the AppLovin family, right? We'll increase your revenues. We'll give you free advertising and Adjust and so on, right? And we'll split whatever sort of the marginal improvement in your revenues may be 50-50. So they don't have to actually acquire these companies. They just kind of bring them into the fold, right? Yeah. And they load them up with the software, start taking away the data, grow those games, right? And then take money and you don't have to do those earnouts, right? So that's another possibility.
Right. And so the other area of growth, and some of the capabilities that they're talking about are, that's kind of rumored, is the ability to do things like auto ROAS, return on ad spend, and things like that. So there may be some capabilities. I mean, we're just going to have to see how things play out post IDFA later this year. But I would say that the Adjust acquisition was it's kind of a high risk, high reward type of play, but it does have the ability to potentially grow their business.
Yeah, I do think that as an independent attribution partner, whatever those revenues were are just going to die, right? Because like nobody's going to pay Adjust to to as a third party to independently provide attribution now, right? Because like they're owned by a competitor. So
yeah, they also actually I shouldn't call this vertical expansion. This is actually more a horizontal expansion in terms of like different verticals.
Right.
Meaning
so not
like,
just games, not
just games, but other industries, and being able to control advertising in those different verticals. And then more horizontal expansion in terms of like more games, more apps, things of that. And so long as customers continue to give them data, they're always going to have a competitive advantage in terms of figuring out where else to go. They could potentially really expand in terms of casual games. And, probably too long to talk about why I personally believe that they can compete most strongly in casual, not mid-core, hardcore games, but, also other apps and things like that. They also have the potential to grow. And then the key risks, as we mentioned, is that, the decline in terms of the ad business, especially with IDFA deprecation. If customers stop trusting them, then they may not have the ability to expand into gaming. Also, we've seen a huge amount of M&A activity. So the number of targets that they could potentially acquire to continue to expand their top line revenue through acquisition
slim
is
pickings,
kind of going away. Very slim pickings. And then just generally loss of trust, because a lot of, I think, what's happening when happened in the industry is that there are now so many, private sort of Slack groups and things like that, where if you do the wrong thing, if you kind of screw someone over,
everybody's going to know.
Everyone's going to know. So so for example, when people found out that Firecraft, the company that basically a Chinese company was set up that was mansion to mansion, and then that the CEO of Firecraft actually for the US entity was actually Adam Ferrugi with his address, that got passed around just like that, right?
Yeah.
and then when they set up like the Firecraft having like a fake office in San Mateo, that was a coffee shop. I mean, that got passed around just like that. People just kind of knew. And so I do think that it's increasingly becoming difficult with these private Slack groups, with social media and things like that.
Yeah.
To be a bad actor. It's just become increasingly difficult.
Well, to be clear, they made it to an IPO and have a valuation of, what is it, like $25-30 billion, right? And that valuation is actually bigger than major competitors, or what might be considered sort of peer companies like Zynga, right? Or Playtika, which are both in the $10 billion range.
Yeah.
And what we're arguing is, okay, they pull these kind of dirty tricks, frankly, on industry partners. And
rumored, right?
Rumored. Rumored, maybe less than ethical moves. And it worked. They grew. They were able to IPO. They're 3 times bigger than their peer companies. Is that founded? Are they going to be able to do that again? Are they going to be able to kind of like turn this around and make it a real growth business? Or was that kind of just like a one-shot deal for them? Right. That's my question.
And by the way, Zynga has also publicly stated that they're going to try to follow the exact same strategy as AppLovin, meaning.
So they're going to acquire an ad network, right?
They're going to try to acquire an ad network. They're going to try to acquire DSP, SSP, MMP, and basically become very similar to AppLovin.
Yeah. So the strategy kind of makes sense. If you're a big game publisher, if you're an ad network, you want to bring those things together to compete in the post IDFA world on iOS, on the App Store, right? You need all those ingredients. I mean, it makes sense.
Yeah. And so for me personally, I would not invest in AppLovin just because I feel like there's to me, there's asymmetric risk in terms. I think that the risks that could potentially hurt their business are far outweigh their potential to like figure stuff out on this side and to be able to expand and grow. I mean, now having said that, I will say this, that they have some of the best sales guys in the world. Like some of the guys, and by the way, on a personal level, some of those guys at AppLovin, whether it's Roth Vivas or Tom or those guys, they are incredibly charismatic, cool dudes you really like and root for, but at the same time, would I trust them? I don't know.
Well, here's the thing: you need those types of guys if you're running this type of company, right?
And I will say that, like, if you look at the history of the business, I mean, they've done things. They've executed incredibly well. They have shown an ability to execute and really get things done. And that,
Matching and Mansion came out of nowhere, man. Yeah. And like was a sensation. Like that whole thing was incredible. They were operating a studio in secret, right? Like nuts, right? Yeah. So credit where credit is due. Yeah.
Right. Now I will say the one other reason I wouldn't invest is just because, to me, like part of my investment strategy is to promote social good. And honestly, like this statement, and this was actually sent to me by like 5-6 people going like, ha ha ha, what is, I personally don't know Adam Frugi at all. Like I don't know him, but this statement about them running their business with integrity, to me, it's just like these words can't just be marketing slogans, right? Like integrity, ethics, they've got to be meaningful and real. And it just like, this to me is just not cool.
Yeah. So, to me, this is fool me once, shame on you. Fool me twice, shame on me. Right. And a lot of people in this business, are very wary now around AppLovin. They've become very big very quickly. They have a $30 billion market cap or whatever it is. I agree. I don't think it's founded. I think it's overvalued by probably 2 or 3 times. Because there are tons of questions around the technology, around their ability to, weather the IDFA storm. The strategy seems directionally correct because we see Zynga adopting it too. And Zynga is probably not going to be the only one, right?
Yeah. And I will say that in terms of like their execution capability, you have to give them credit for their ability to execute against opportunities. They're very, very impressive in terms of their ability to identify opportunities, go after them, and execute against them. Ethics aside, I mean, I definitely think that they're very impressive in that area. But for me personally, looking at kind of the cash flow characteristics of the business against operations, which I think are overstated, that when we look at the market cap of AppLovin at about 23 billion here relative to a Zynga, which is, less than half. Yeah. But with higher revenue.
Doesn't seem right.
Yeah, it doesn't seem right, because I do think a lot of the other parts of the business, as we mentioned, are likely going to slow. So long story short, I personally am passing on AppLovin. Again, we are not professional investment advisors, but these are our opinions.
Yes, I too am passing on AppLovin. And I'm not sure I buy the growth story. Like you just did a masterful S-1 breakdown, value style, Joe, which we haven't really done on this show, right? It's been more about, what's the growth story? Like, do we believe in these companies? Do we believe in leadership, right? And from that standpoint, it's like, we believe in mobile games. We believe in the industry because we both work in that industry, right? It's an industry that is growing really fast and transforming. It's changing very quickly, and AppLovin seems to have the right idea. They do have the ability to execute. I completely agree with that. We've seen them do it. They've accomplished pretty amazing things. Again, ethics aside, it's just, can they be the winner in this space? To justify this valuation? I don't think so. There's a bunch of incumbents that can fast follow them down this path. And, these guys don't have the best reputation, and that's going to be a problem for them.
Yeah. But I will say, so for people who are positive on AppLovin, I think the thing to watch out for would be do companies continue to use their ad network and give them data?
Yeah.
What will they do with the Adjust acquisition? Will they be able to continue to do third-party attribution? Will they continue, or will they be able to transform themselves into a SAN? Will they be able to turn on capabilities like auto ROAS and things like that? Those would be things that I would watch out for. And then it's really going to be like this next phase for them is really going to be about, the first leg of growth for them was the ad network, and they did a masterful job there.
Yeah.
The second leg of their growth was entering the mobile gaming market, and they did a masterful job there.
Yeah.
But now we're talking based on the valuation, there's expectations of them entering a third leg of growth. Now, what's that going to be, right?
They want to be the Netflix of mobile games, right? That's the slogan, right? And it's like, okay, how can you be Netflix if you don't own the platform? Right? They don't own the App Store on Google or iTunes, right? Number one. Number two, they don't have a storefront, right? They're going to rely on shuffling players around games in a way that Netflix, like they have the Netflix application, like, is there going to be an AppLovin application? Probably not, is my guess. It's number three, like they don't have a subscription-based revenue model. It's not a churn limitation model. It's going to be free to play, which is better in some ways and worse in others, right? Because you're relying on the ability for all these disparate games and partners to get their monetization strategies right.
But I will say, if game companies continue to give them data, I do think that they can continue to generate more gaming revenue against casual games.
Yeah, I agree with that. But they're going to have to take small fry and turn them into like medium fry, in order for this to work.
And then, you should also just watch for how much they're able to expand outside of games, and then, who knows, maybe they'll start launching like
utilities,
Tinder and,
dating, meditation apps, right?
And they'll know exactly what ad creatives to run. So
yeah, exactly. Joe, I don't think we have time for Coinbase this week, man.
Okay.
Yeah. Well, and plus I didn't do anywhere near as good of a job as you did. So maybe I'll do the S1 next week and we do Coinbase then.
All right, let's do it.
Yeah, right on. This was great.
All right, then in that case, there we have it. AppLovin. All right, until next time, everybody. Bye.
Bye.